Hello traders, Mark Heworth here with Flipside Trading. And today we want to talk about some market activity. Basically, why did the market rally in such an extensive fashion amidst the overhang of the coronavirus, right? So let's look at the central banks and what they're doing versus the overall fundamentals of the economy. Amidst all that, here we are in a rising market, and on Thursday we take a call vertical. Why do we go against the trend? And then lastly, let's take a look at some key support and potential targets of the market going forward. So without further ado, let's jump right in and get into the charts. So let me pop out of here real quick. All right, so we want to go a little bit of context. What we're looking at right now is the S&P 500 futures E-minis on a daily basis. And you can see here is when we started to getting the onset of the coronavirus, and that started driving the market down. And it drove the market down because it's having just a huge economic impact, right? If we can't move goods and services from the second largest economy in the world, then that's going to have a drawdown not only on China's economy, but given that so much of our supply chain is Asia-based these days, Foxconn is closed now for a month, and they're the major supplier of Apple. How are they going to maintain their overall, supply chains and productivity growth and the ability actually to produce products? So we have this huge drive, this huge push down, and because of that, you can see it not only reflected in the price of the S&P 500, but also let's see if I can. But also in the major commodities, which are kind of, should we say, our signals and growth indicators. So let's take a look at copper, right? So look at copper. I mean, copper just absolutely cratered. It just got crushed, right? Because the people saw that the use of copper and everything from housing and wiring to semiconductors. That demand is going to be curtailed by the coronavirus, and therefore we had that same reflection. And the same thing, if we take a look at oil, right, the other, should we say, broad economic world growth indicator, oil also, at this point in time, broke here from underneath this bear flag that basically formed the bottom of the channel on the daily chart. And what happened? Boom, we just got a crush. Now notice a couple things here, and I'll go back to copper as well. We came back to the bottom of a longer-term trend line, and let me take this off and zoom in for you. Right, we came into this longer-term trend line, and we kind of held for the moment. Right, we're kind of thinking and we're kind of stopping. But the key thing is that here we have, you can see that the bottom of value, this white line here, is still rejecting it, right? We still have this rejection into this daily value area, saying that, price is not finding an auction level where people are willing to buy. And these tails right here keep showing us the rejection. So we're not out of the woods yet. And the same thing happened in copper, right? Even though you have a long, push down, there's always a chance that you could have a bounce. But those bounces basically have been curtailed or limited by, should we say, what we call fair value. And if we take a look at copper right here, and you don't see it on the daily, but if you go to the weekly, and let's see, you can see it tried to enter this value area right here and got firmly rejected for the week. So this also tells you that this is one of those dead cat bounces where the market overreacts and it becomes oversold, and it comes back a little bit, and then it may continue its direction forward. So saying that, right, let's just kind of summarize a little bit about the nature of coronavirus and the potential impact it has on the economy. So let's go back to our slides real quick, and let's go here, and we'll blow it up for you so we can see. So we have to remember now, right? The Chinese government is taking unprecedented measures that could probably only happen in their style of government, right? And that's the quarantine of an estimated 50 to 60 million people. Now think about that from a scale perspective. That's like putting New York, Chicago, Los Angeles, and Dallas all under quarantine. Huge, right? You have school and factory closures, not just due to the New Year's holiday, the Chinese Lunar New Year, but all the way into March. Same thing, flight cancellations from outside, from the US, Europe, even smaller airlines that are aligned more with China, like Iran, have closed, direct flights, to China into the whole March, April timeframe. So we're talking a whole month without this type of transportation interaction to develop goods, innovations, service agreements, contracts in order to keep the flow of trade going. In addition, many companies in China have now declared force majeure, and basically because of the coronavirus, saying that we have now a cataclysmic event, and they're canceling the contractual deliveries of oil and copper, as you saw, right? Also natural gas, and even potentially U.S. agricultural products. Based upon the trade agreement. Remember, we were supposed to buy something like between 50 and 60 billion, dollars a year of agricultural products that China was gonna, step back up to the plate to. So if that's the case, and we can see, we'll go a little further here. We still have, pretty much this exponential, rise in the number of cases of coronavirus. Now, if it starts to flatten off, could that be potentially good for the market? Yes. But you have to remember, not everything moves in a straight line, right? Given the incubation periods that happen, a lot of times you get these spikes. It'll continue flat for a while, and then it'll accelerate upwards again. So be careful on that elbow. Don't get sucked in, on those pieces. But even though the market may. But it's something just to keep in the back of your mind. So the big question becomes then, if all this is weighing on the market, and commodities and fundamentals are telling us that we're not growing, and let's see if we can't move down here, and we take a look at earnings, right? We're in the midst of earnings seasons, and now we have this huge divergence between kind of what the consensus looking forward is and what the actual is saying. Hey, we're not meeting our overall expectations. What's happening, right? This is the Dow as far as the overall price. This is EPS. So it's telling you that the earnings per share are not supporting price. So basically all our fundamentals, right? Earnings per share, in the Dow, our commodity structures, which indicate kind of worldwide growth, are all going down. And yet we come back and we take a look at the markets real quick. And here you go. We go back to let's go back to the S&P 500. And we go back to S&P 500. We'll drop it back into the daily time frame here, and you can see that we've erased this whole drop this whole past week, and actually went and set all new time highs. Now, why? Given all that negative fundamental structure, why did that happen? Well, it comes down to one thing. It comes down to the central banks. Never underestimate the power of the central banks. So again, we're going to flip back out real quick, and we're going to go over back to our slides, and we're going to come out down here, and we're going to take a look at, first of all, the Bank of China. What did they do? All right. So first of all, they were closed that whole week that we saw that downtrend with the onset of the coronavirus due to the Lunar New Year. But on Monday, what they've done is they had a huge liquidity injection. Number one, they set an all-time record for liquidity injection, right? Equivalent to about 174 billion. On top of that, they banned short selling, so they can't push the markets down any further. They reduced the repo rate to make it easier to borrow money from the central bank itself. And of course, they reduced the reserve ratio on the general governmental and commercial banks such that they don't need to have as much on reserve in order to increase lending. So they put all of that into pressure, right? They injected all this cash through these various mechanisms into the market, which helped boost the market up. Now, it wasn't just the Bank of China. The Fed also, has stepped in and their repo operations, which they can, keep calling not quantitative easing. And here are the figures from the Federal Bank of New York for this week only. Basically, we've injected $261 billion into the daily repo operations just this week. And of course, what did it do? It pushed the market up. All right, so never fight the central banks. At some point in time, there is a limited ability. I don't know where that theoretically is, where we can no longer monetize the debt. And when we can no longer monetize the debt, we're going to have to pay the piper, and that's going to be in a huge economic crisis. Is that anywhere on the horizon? Absolutely not. Is that something we're making a prediction on from a timing perspective? No, but we can monitor these things and begin to look when the markets begin to deteriorate in order then to adjust our overall investment strategy. Okay, so now the question becomes, as we saw that we had the huge rise this week, everything's going up, central banks are kicking in, why do we then take a call credit spread on Thursday? Well, basically because we can see that the market itself is starting to weaken. So let's take a look at the top here. We're at this graph. We're looking at the overall advanced decline ratio of the New York Stock Exchange, okay, which is bigger than the S&P 500. This represents about 3,600 stocks. And you can see that we had our key peak right here, and our previous peak in the market, is that we also had a brand new high in the overall advanced decline, meaning that more stocks were advancing than they were declining. Well, now we come up here to this on Thursday, and we see the market is setting new overall all-time highs, especially on the overnight section, and we see that we are getting a negative divergence right here and starting to move down on the advanced decline, meaning that stocks are not participating in this overall move upwards, signaling weakness. Okay, another measure, right, of that same type of advanced decline weakness, or should we say market breadth, showing weakness, is let's take a look at the stocks that are over their 50-day moving average, and we can see here, right, we'll take a look at the same type of analysis. Right, here's our here's our previous all-time high, and we see that the stocks above the 50-day moving average, right, they're also moving up. They're presenting us a peak that corresponds to this high here. But here we are now at this high here, and look at the scope and the depth of this divergence. This tells us that, at least from the interim basis, maybe near term, that we could be running out of a little bit of steam, and it makes it probable, gives good probability that we can go ahead and place a call credit spread. And let's get out of all this. We'll go back to the charts, and we go back to the chart, and we'll go here, and you can see that we were fine, and that we definitely had a down day. So, but what makes it so we have a down day, and how do we know that we're not going to get in any trouble and that we have to defend any type of spread? So let's go back down to the 5-minute time frame, if you will, on this credit spread. And so here we are. Okay, we're going to look at this area. I'm going to highlight it for you. Right, this is the actual day, all the way out to all the way here. Right, we're going to look at this time frame. So the market opened lower, which was fantastic. It stayed down, and then it came all the way back up to value. So this value becomes one of our key overall resistance areas to help us determine if we need to manage the credit spread at 33.40. Even at this area, 33.40, we had a 33.75 short strike. We're definitely not in any danger, but you can see that we got firmly rejected. We got a little bit of bounce, and again, we got another rejection, and guess what happened? Came all the way back down, and it hit this VPOC level right here, right? This pink line. So this was a great short for day traders here at the end of the day, off our secondary bounce, hitting our overall target right here. So that was awesome. So the combination of what we looked at from the market fundamental perspective, as well as looking at, we had these interim, resistance levels, saw that we had no pressure whatsoever in association with our call credit spread being at 33.75, and we're able to maximize full profit on that. Okay, so the bigger question is, where is the market going? So That's hard. That's hard to say. I can't say if it's going to go up or down next week. We're going to have to wait and see how the coronavirus continues to manifest itself as far as number of cases. And we're also going to have to take a look at how much more central bank intervention do we have in order to prop up the markets. So on the upside, let's take a look at where this can get to. So right now you can see we have this R1 level at 33.80. That's a really good kind of interim standpoint for the week. And it actually also corresponds with a great fib retracement level. No, I'm sorry, I'm in the wrong area here. So we'll go ahead and get that drawing up and we'll show what that looks like. So we're going to draw this fib. Sorry about that. I forgot that you have to actually plot it on the overall high we want to start it from. So let's start it from here. We'll add that drawing, come down, and we can see that this fib extension from the 127 comes pretty close, or basically right on. I think it's this one right here. Yeah, right around this 32.80. So we have a big confluence. So 33.80 is very, very key for where you want to be from a potential resistance standpoint next week. From a support perspective, right here, we'll blow this up a little bit. Right, the top of value right here at 3,300 is a very key level. And then, obviously dropping all the way back down to the bottom of value at 32.32, kind of worst case. I don't expect the market to drop that far unless the central banks really, don't participate. But maybe we can get a better view of this if you take a look at the hourly, and we look at the top of the value from the hourly perspective. It comes really down at the 32.75. So 3,300 is kind of number one. 32.75 is number two. And the great thing is, if you look at 32.75 from kind of your, all out, if we look at the SPX, which is actually the cash piece, the other key, that really falls into play. Let's kind of bring this in a little bit. Right here, this 32.80 is the top of the gap. So that's also another confluence. So if I had to look at support, 33.13, top of the gap, 3,300, which is the daily top of value, and then all the way down here to 32.80, which is the hourly top of value, which also corresponds to the SPX top of the gap. So anyway, that's where we'll be looking at the market to travel. We'll have to wait and see, and we'll try to take advantage of that, knowing we have these key levels then to place trades against, and we'll go forward hopefully for another profitable week. All right, folks, thanks for your time, and we'll catch you on the flip side.